So the RBA, let's get this out of the way. They're not going to do anything today, huh?
I'm not expecting so, but, we'll wait and see.
Okay, so 1.5% is the rate. They're going to probably stay on hold. But also, the bets have increased that by sometime later this year, they need to cut. Maybe, I think 20% of the odds right now. Still pretty low. So what is the dilemma, though, that they have? Because they still have inflated, Eastern Seaboard prices in the property market, but also sluggishness elsewhere in the economy.
Yeah, so the economy is slowing down, and we've seen that in the GDP numbers. So, kind of classic theory here would be that they'd be veering towards a possibility of a cut. But on the other hand, they've got very inflated house prices. That there's a concern, particularly around Eastern Seaboard, Sydney and Melbourne.
$970,000, nearly $1 million median house price right now.
So, if it was possible, I think the RBA would love to cut for the corporate sector and possibly certain geographies within Australia and raise on the east. But they can't do that. So what they've done is, I'm guessing here, is keep rates on hold and use macroprudential rules to try and take the heat out of the housing market. And we've seen these speed limits put on investor properties and now interest-only borrowing to try and achieve that.
And you were also raising some mortgage rates, doing the job, the targeted I think moves as well.
Yeah, so the outcome of this macroprudential, these speed limits, one of the tools, not the only tool, but one of the tools the banks have is to change the pricing on some of those mortgages, increase the price to slow down demand. So yes, we're kind of doing a little bit of the work for the RBA around housing.
Now, in March, the OECD said the biggest risk to the Australian economy is a crash in property. Would you agree with that?
Well, when you look at the numbers and just think, where is the largest exposure? Yes, and we think that's a really low probability, by the way. But it's certainly something that we stress test a lot and think about. I mean, there are some very real differences in the Australian market compared to, say, the US or Europe that suggest that that's less likely. But on the face of it, it is certainly a risk.
I mean, are the good times over for the banks? I mean, you're under a reshaping of ANZ. You want to make yourself more agile, but, you have margin pressures. You have more, obviously, interventionist government. You have this bank levy that is going to be imposed. Slowing consumer credit outlook as well. I mean, are the good times over?
Well, I think they're getting tougher. I mean, I'm not sure it's ever been good times. It's always been hard work running a bank. But I think the point is that what's driven bank earnings over the last really 20 years has been an increase in household leverage, which has been afforded because of lowering of interest rates. Well, that's just not going to drive the future. And so the future is going to be different. And so we've been getting ready for that at ANZ for a little while, expecting a lower growth outlook. How do you succeed in that? It's all about, capital efficiency and productivity. And so that's what we've been shifting our attention to.
What about the bank levy? You've called it a regrettable policy, but also among the big banks, you've been more, can we say, having a more conciliatory tone? Are you more resigned to the fact that it's going to happen?
Well, we are resigned to it is going to happen. I mean, all parts of Parliament support it. It is regrettable. We don't think it's good policy. We think it will have unintended consequences. But the point, we've seen very little value in kind of bleating about it. Really, we should be getting on with the government, trying to work out how best to implement this to avoid those unintended consequences.
Are you worried that it could take a precedent, though, and you can have further bank levies?
Well, certainly our investors are. They're worried less about the financial implication of this levy, which is probably manageable, but more about what it says about the relationship, what it says about government policy between government and industry in general, but particularly around the banks. And, we've seen in other parts of the world, the UK in particular, it starts in one way and then changes form over time. So that's what people are worried a little about.
Are we really heading towards a prolonged, slower growth or even negative growth environment in Australia? You haven't had 2 quarter-on-quarter periods of negative growth, recession, since the early 1990s.
That's right.
Is this something that the average person in Australia is going to have to get used to, and the investors in the banks are going to have to get used to lower profits at the banks as well?
I think there's certainly going to be lower growth. I mean, the Australian system has done a remarkably good job of transitioning from this massive mining investment boom we had. And it's moved into a bit of a construction-led boom, and that's based on good fundamentals, strong household formation, strong migration into the country. And now it's a question of that's got to come to an end. What's next? So I would suggest that growth is going to be much harder to come by. And of course, if we've been used to very good growth for 30 years, low growth feels like a recession to a lot of our people and a lot of our consumers. So they're already starting to act differently when they're seeing that kind of flat growth.
Do you believe that this commodity super cycle is pretty much over, or
Look,
these are cyclical things?
Commodity cycle, it's not my job to predict where commodity does. All we know they're going to be volatile.
Yeah.
It's been an enormous benefit to Australia, but I don't think we should count on another run-up in commodity prices for our future.
Let's talk about assets and the reshaping of ANZ, because you have sold off UDC Finance to HNA Group here of China. You sold your stake in Shanghai Rural Commercial Bank, and we're looking at also other assets, 39% of PT Bank, Pan Indonesia, and then the other one, AmBank, AMMB Holdings in Malaysia. What's next to perhaps sell?
Well, they're really it, and we've got another thing that we're looking at, which is really reshaping our wealth business in Australia.
That's right.
And the reason for those is, as I mentioned, in a lower growth environment.
Because you sold your wealth management to DBS in 5 Asian cities.
Yes, our retail and wealth business in 5 countries here in Asia, pretty small business. Look, in that lower growth environment, you've got to be really on your game. And we get a choice here to say we should pick a few things and do those incredibly well. And much better to have our intellectual and our financial resources focused on our core businesses. And these just aren't core. They've served us well, these stakes, but it's time really they move on.
Let's talk about the AmBank possible sale, because RHB has gotten approval by the central bank in Malaysia to perhaps buy that stake or merge that in. 23.9% stake.
Yes.
But there's a lot of loose strings from 1MDB and a lot of things that could jeopardize it. Are you confident that this sale could go through, and at the valuation that some have said, like 1 times book?
Look, we're hopeful. We don't really know a lot of the details. We're a shareholder. We're waiting to see all the details. I mean, the way things work in Malaysia under the regulation there is the parties seek approval to negotiate. That approval's been given, and so now the companies, AMMB and RHB, sit down and nut out a deal, and then they'll bring that to shareholders. So we don't really know the details. It's a good thing for ANZ. I think it's a good thing for AmBank to move forward and seek some scale in a tough market.